So by now, we all know the announcement last week by the Federal Reserve of open-ended asset buying shook the commodity and financial markets Thursday and Friday. But will the aftershocks continue to be felt this week? We'll be asking Vince Lanci on a special QE edition of Reset. Joining me now is Vince Lanci. Vince, thank you so much for being with me.
Daniela, thanks for having me.
So Vince, I'm sorry, but you know I'm gonna have to call you out because you thought for the longest time Ben wouldn't do anything.
No, I'm sorry. This is a bad connection. I can't hear you. I have to go. Yes, I have been pounding tables for the last month. I've broken tables and now I have to pay for that. I thought it was ridiculous that Bernanke would do anything to avoid being labeled political heading into an election. But boy, was I wrong.
And boy, Vince, did the Fed deliver. They will be buying $40 billion a month of mortgage-backed securities and continuing with its Operation Twist program. It will be buying $85 billion in assets until the end of year at least.
Yes, he did announce that. And there were several major differences, not just in what he said, but how the plan will be implemented. The first is that the bond market, the traditional bond market, is not the target. It's the mortgage-backed security market. So you'll start to see those appreciate relative to bonds. The second two things are actually more important. One of them being that the Fed is now shifting from a philosophy of stock or inventory versus flow. And these are terms that are used to describe bond repurchases. And the second is some terms that he said that make it not only open-ended, but hard to time when it will end in any way, shape, or form. So this is a major, major departure from previous QEs.
So Vince, I know there was one statement we wanted to focus on that Bernanke made that you found quite dovish when he says a highly accommodative stance of monetary policy will remain appropriate for a considerable time after the economic recovery strengthens. Why did you think this was key?
Yeah, I think the word after, it says it all. The word after says it's not ending or we're doing other things. We're going to continue doing this after the economy recovers. So he basically just let everything go. And it's a particularly dovish statement than what he has said before. And really, I think what Ben's trying to do is he's trying to really avoid and differentiate what the Bank of Japan did 15 years ago. And that is, if you go with, as I said before, stock flow versus stock in terms of your repurchases, and essentially make it open-ended, you're going to have more success in fighting deflation, which is entirely what his goal is.
So Vince, why do you think Bernanke chose now to deliver this POW to the market? Did he have no other choice?
I don't know why he picked now to do it. The facts, the math would say he didn't have to do it now. The stock market was near its highs. Other markets, Europe notwithstanding, I really don't have an answer as to why he timed it now. Why couldn't it have waited till after the new year? I don't know. Perhaps the data that we haven't seen yet that he has seen that is scaring him.
And Vince, if we look at the Kitco News Gold survey that was published on Friday, 24 out of the 29 respondents feel bullish for gold this week. I know you feel the same. Offline, you were saying there should be nothing stopping gold right now. Yeah,
I think, as we've said before, above 1680, the market's going to start having bigger ranges, and we believe it will work its way to 1900. We have higher targets than that now as a result of our probability engine. But I find little reason to be cautious right now. I think what you're going to see is one of two things, or a combination. The market will move in an orderly fashion higher for a long time until Ben Bernanke says, I'm not doing it anymore. Or you're going to have very whippy markets where longs sell to new longs, big dips to buy, big rallies to sell. But we're in all the areas on our technical and mechanical models that say you should just be long.
So Vince, last time we spoke, you were looking at 1900 gold. I now know you've reevaluated everything. You have higher targets. What numbers are you looking at?
Well, yeah, we reevaluated above 17 and a quarter. Or we didn't reevaluate, the machine reevaluated. We're just people, we don't know what we're doing. But above 1680, we were satisfied to say, okay, 1720 is our next target. And when it got there, we reran our probability engine, and our target was 1750 area. And then it gave us then it moved that to 1830, which we were happy with. We understood that. And then it gave us targets over 2,000 and over 2,300 in the next 6 months. So I think that's outrageous. And I'm not saying that those are going to happen, but those are outlier targets. Like, do not be surprised if we go to 2,500.
So market watchers have told me, Vince, that two statements were key for precious metals in that Fed announcement. The open-ended nature of the statement, which is a sea change for the Fed, and the comments about the inflation target, which they saw especially bullish for gold.
Right. So you immediately have to ask yourself, if you're a trader or if you're thinking that way, all right, so what's wrong with this picture? What can make gold go down? And we're trying, and I other than people taking profits or margin raises, if you're a bit of a conspiracy theorist and you're wearing a tinfoil hat, sure, margins could be raised. That could keep a lid on things. But we don't see anything getting in the way of either a whippy or orderly rally.
Vince, what about if the Republicans come into power?
I don't care who's in power. No disrespect to you intended. I don't care who's in power. They have to print. They will print. They have to print. They must print.
So Vince, how are you expecting the US dollar to react to all of this?
By using the euro as proxy, the euro has broken out very strong. And that's on the reaction, that's on the move this is actually coming back to the dollar. The dollar is weaker because of anticipation of monetization of debt, which is now coming in a big, extended, unpredictable way. The euro has been rallying because of that, and because people believe Europe will do what is necessary at some point to save its own currency. So ironically, if you look forward, the Fed has done what they need to do. Europe is going to do it now. What will that do to the euro? It will counterintuitively strengthen the euro. A printing of euros will strengthen the euro because people will be less scared of being in Europe because there's more currency. And then in the long run, the euro will start circling the drain as well. So there are less and less and less fiat currency alternatives to hedge your dollar exposure. And that's why gold is going to benefit. You can only put so much money in Thai bahts. You need to use something else.
So no stopping gold now, Vince. Will this be helping the other metals as well if we look at silver?
Yes, it will, although a fundamentalist wouldn't make the case. Silver is, part industrial, part precious. Silver is not something that central banks own. Gold is. So you would think, and I've seen players in the market putting this spread on, buy gold, sell silver. I think that's always dangerous. Silver is more thinly traded, and silver is the metal of the masses. The common man is going to buy it 1 ounce at a time, and silver is going to benefit very much so. The metal, I think, that needs to be paid attention to, at least as a barometer of recovery, is platinum. But the platinum gold spread has been coming in for the last week or so, and platinum is the metal that is a sign of recovery. It's not a metal like gold, which will be a substitute for currency. So,
right, but platinum is also riding the heels of the South African labor issues right now.
Yes, exactly. Labor issues are driving platinum and palladium more than anything else right now.
So now, Vince, I'd like to introduce a new part of Reset. We're going to be looking at a term of the week. This is something that our viewers have asked of us, and we've received a lot of emails of people who want you to explain the term contango.
I think most of your viewers know what contango is, especially if they're in the commodity markets, but I'll put a fine point on it. Broadly speaking, contango describes a futures market where the short-dated futures are underneath or at a lower price than the backdated futures. What I think a lot of people do not understand or some people don't understand, is the reason for it. There are several components that create the spread from the front month to the back month, low to high. Those components, depending on the commodity, are supply and demand and fungibility. So if you're bringing oil out of the ground today, can you use it for deferred sale, or is it needed now? Well, to the extent that you have to store it and that it's used, there's your contango. But just staying with gold, gold is fungible. There's no difference between this gold and next month's gold. There's no crop issue. And so the curve in gold, the term structure in gold, and this is very important, especially in options, the term structure in gold is entirely determined, almost entirely determined by the cost of money. So if you want to buy gold today, it costs $1,700. If you want to take delivery of gold 6 months from now, it's $3 higher. What does that $3 differential mean? If you buy a future 6 months from now, it's $3 more than the spot price. That differential is the cost of carry, or opportunity cost of tying up your money in gold versus interest rates. And the bottom line here is, as interest rates go down, contango decreases in a market like gold. Silver's contango situation can, however, reverse and become backwardated because of short-term supply-demand glitches, and platinum as well. But that's for another conversation. And what a contangled world we live in, Vince. Finally, let's look at the week ahead. Let's look at the economic calendar, some key events for the week. We have Ben Bernanke scheduled to speak Wednesday again. We have existing home sales coming out Wednesday as well. Jobless claims coming out Thursday. Philadelphia Fed survey also coming out this Thursday. What do you think we should be paying attention to? Well, those numbers have been very, very important over the last couple months, as people use those as an excuse or non-reason to bet on a QE3. Now that we know that we have a QE3, the reactions to those numbers will be muted. Markets will gyrate, but I think we should be focusing more on who or what is going to move on the chessboard next, and I think that's going to be Europe. Vince, I want to thank you for doing this extended and special quantitative easing edition of Reset. Thank you so much. Oh, my pleasure, and have a great week. We'll see you next week, Vince. Thank you for watching. In the meantime, you can email me any comments or questions or terms you would like explained by Vince Lanci at newsfeedback@kitco.com. For Kitco News, I'm Daniela Cambone.